Welcome to Managerial Accounting, Lesson 7, Chapter 9. In Lesson 7, we examine performance measurement in decentralized organizations. We begin with the advantages and disadvantages of decentralization. Next, we look at the return on investment analysis of performance. The concept of residual income is introduced next. Several other performance measures are added, including delivery cycle time, throughput time, and manufacturing cycle efficiency. And we conclude with a balanced scorecard concept. As you may have guessed, each of these ideas are relatively recent additions to the toolkit of the managerial accountant. They are most likely to be found in the more progressive firms and those firms with more enlightened leadership. When an organization is decentralized, decision-making authority is spread throughout the organization rather than being confined to a few key executives. The larger and more complex the business, the more decision-making needs to be delegated. The advantages are manifold. Customer response time is improved. Motivation and job satisfaction are enhanced. Lower-level managers are better prepared for advancement. Top-level managers have more time for strategic planning. There are disadvantages as well. Decision-making can lack coordination. The objectives of a division may clash with those of the entire organization, and lower-level managers may lack perspective. One useful means of controlling some of the negative aspects of decentralization is termed responsibility accounting. Each manager is made responsible for only those factors she or he controls. These include revenues, costs, profits, and investments. Managers are graded by performance only on those aspects of the job that apply to them. Of course, some can be evaluated on more than one of those four items. Investment managers are evaluated using a measurement called return on investment, or ROI. ROI is defined as net operating income divided by average operating assets. Net operating income is income before interest and taxes, and is also called EBIT, or EBIT. Operating assets include both short and long-term assets held for operating purposes. Because long-term assets are depreciated over time, the denominator of the return on investment measure decreases with increases in overall, which increases overall ROI automatically. One way to eliminate this bias is to consider only asset costs and ignore depreciation when calculating ROI. This common practice, the most common practice, by the way, is net asset valuation, where the purchase price minus accumulated depreciation is used as our asset value. When we discard the depreciation expenses, we call that gross asset valuation. It's only practiced by a minority of firms. The more common practice is the net asset. Alternative definitions of return on investment will increase your understanding. ROI is equal to margin times turnover. Margin is equal to NOI, or net operating income, divided by sales. And turnover equals sales divided by average operating assets. Combining these terms gives us what's called the DuPont formula, which was pioneered by E.I. DuPont Nemours and Company. Exhibit 9.1 shows how the system operates throughout the organization. Take a careful look at the organization chart and commit it to your understanding. Of course, there are several valid criticisms of the use of ROI to evaluate managerial performance, and these are listed just following Exhibit 9.1. Another approach is to use residual income to measure performance. This is defined as the income above the minimum required return on assets. Economic value added is one example of a refinement to the ROI principle. The text does not go into the distinctions at this time. This is deemed a more advanced accounting procedure and is not widely spread. Operating performance measures are introduced next. These include delivery cycle time, throughput time, and manufacturing cycle efficiency. Each is defined and discussed briefly. Each has its own extensive literature as well. Finally, the balanced scorecard is introduced and discussed. Under this system, management translates its strategy into performance measures that employees can understand and influence. Some of these measures can be qualitative rather than quantitative. Customer satisfaction or retention, for instance. Why do companies fail to execute their strategies? Interesting question that's answered on page 414 of the book. First, only 5% of a company's workforce understands the organization's strategy. Second, 85% of management teams spend less than 1 hour per week discussing strategy. Third, 60% of companies do not link budgets and strategies. And finally, only 25% of managers have their incentives linked to strategic metrics. This footnote we credit to Robert Palladino on page 414. Take a close look at it. My personal experience of business would bear out these statistics. And although we often say 68% of all statistics are made up on the spot, these actually come from the text. Enjoy reading the chapter. We are nearing the final result, which will be next week, and we'll prepare a good lesson plan for you then, and discuss also at that time the final exam. Thank you very much. Goodbye.